Greetings fellow engineering economics enthusiasts. Welcome to today's extended lesson on calculating remaining loan balances after partial repayments. Loans are a fundamental component of finance and engineering economics. The ability to intuitively understand loans, interest accumulation, and repayments is an invaluable skill we will be building today. I appreciate you joining me for this in-depth lesson. Make sure to grab some coffee or tea, get comfortable, and have a pencil and paper handy for working through examples. Let's dive in. A loan, at its core, represents an amount of money borrowed that must eventually be paid back, generally with interest. The interest rate is the cost of borrowing, say 5% or 15% per year. Loans provide access to capital upfront that can be used to purchase assets, invest in projects, or fund operations. However, the trade-off is that you end up paying more than originally borrowed due to accumulating interest charges over time. Some key characteristics of loans include original principal, the upfront amount borrowed; term, the loan period before repayment is completed; interest rate, the annual cost of borrowing, compounded periodically; payments, periodic payments made toward the balance. One critical concept is the time value of money. Money today is worth more than the same amount in the future due to its potential earning capacity. Interest rates account for this. As interest accrues on a loan, the balance owed grows larger. This dynamic balance is important to model properly when evaluating loans. Walking through an example, let's look at an example to make this concrete. Suppose you borrow $100,000 at an 8% annual interest rate for 10 years. In year 5, you make a lump sum payment of $25,000. How much is still owed after that payment? First, calculate the future balance after 5 years before accounting for the payment. Multiply the present value by 1 plus the interest rate raised to the power of the number of compounding periods. Here, we take $100,000 multiplied by 1 plus 0.08 raised to the 5th power. This equals $100,000 by 1.469 equals $146,900. Therefore, after 5 years of compounding interest, the balance has grown to $146,900. Now, we simply take this future balance and subtract the $25,000 payment. The balance after payment equals the future balance minus the payment amount. In this case, $146,900. $25,000 equals $121,900. So the amount still owed after the year 5 payment is $121,900. The interest caused the balance to grow each year, but the lump sum payment reduced the principal. Interest will continue accumulating on the remaining $121,900 balance. Additional examples. Let's look at a few more examples to reinforce these concepts. 1. A $20,000 loan at 6% interest has a payment of $5,000 after 3 years. What's the balance after this payment? 2. A $50,000 loan at 10% interest has 5 annual payments of $10,000. What's the balance after all payments? 3. A $200,000 loan at 12% interest has a $40,000 payment at the end of year 2 and year 4. What's owed after these payments? Pause and work through these step by step before unpausing. Calculating these in your head will reinforce the loan balance concepts we've covered today. Today we went on an in-depth exploration of loans, including interest accumulation, lump sum repayments, and calculating dynamic balances. Being able to analyze loans is an essential financial skill for engineers and project managers. I hope you feel more confident in modeling loan balances and payments. Let me know if you have any remaining questions. I look forward to our next lesson. Keep honing your engineering economics skills.